Welcome to the Radical Middle Podcast, where we believe the right solutions start with asking the right questions. With your host, Thomas McMurtry.
Hi there, welcome back. This is Thomas McMurtry. Welcome back to the Radical Middle Podcast. I'm super excited today to be joined by my friend here, Ian Hull. We have a great topic today. We're looking at how banks create money. It's a fun time to discuss it. As you may or may not know, Ian, we have a central banker in the Prime Minister's office here. So hopefully he knows all about this topic. Worked at some fine establishments. But I wanted to quickly turn the wheels on you for a second and ask you how you believe that banks create money. I'm not sure if you've done any research off the top.
Yeah, for sure, Thomas. And, it's a great discussion because, here I am. I've been running a business for almost 35 years. I have run a family, borrowed money, and I can safely say I'm not really sure how it was created, except I always thought it was just printed. And on what basis it's printed, I've never really followed and understood. So today I really want to sort of drill down on it because I learned so much in our last podcast about borrowing as to assets and how borrowing against real estate and residential real estate, essentially in Canada, has effectively stifled our economy a little bit. And so, as you say, we have a prime minister now who was a former central banker, a wise guy in that regard. Forget the politics aside, accomplished in that regard. So I am interested to hear a little bit about just some of the basics about the banking systems, and I think that's such an important element to all of us. But when you're a young person coming into the game of finance and earning money and struggling through your own choices financially, how is the banking industry set up, and on what sort of foundational basis is it there?
Yeah, well, if you may allow me here, I'll take us on a little bit of a history lesson, perhaps a brief as possible, Ian. But Mark Carney's a good example. Politics aside, he's got a great veneer. Like central bankers have this veneer of reliability, trustability, and this goes back centuries, and it's intentional. But partially this whole understanding, which I think is very central to the economy of how banks create money, is a little obfuscated, even in modern textbooks. So as you know, I just completed a degree in international economics, my master's, and there's still a lot of confusion about this. The textbooks still teach what's known as sort of the financial intermediation theory, which is the idea that banks take deposits and lend them out. And there's the newer version of that, which is often used, if you'll allow me, by the Austrian school. Sort of the Bitcoin, the crypto community is big in this sort of Austrian school, which is really free market ideology. And they have some great critiques. I'm a big fan of Friedrich von Hayek, or Hayek and von Mises, but they have what's called the fractional reserve approach to banking. And this is sort of the modern theory. You will get this in textbooks. And it goes back to the foundation of banking, right? So you had gold was the main currency, and you had people wanted to store their gold in a safe place. And where was the best place? The goldsmiths. They were already storing their own gold. They had secure facilities. So instead of bringing your gold to buy things, you just stored your gold with these, would-be bankers. And what ended up happening was you traded on promissory notes that, okay, my gold is here, here's so-and-so percentage, right? So over time, of course, the bankers realized no one is really coming to get this gold. So if we just keep a solid reserve, we can lend out the rest of this which is new money. So I can loan you money, loan you this gold on maybe your business venture. You have, whatever it may be, knowing that hopefully not everyone will get wise that not all the gold is there. So that's the idea of fractional reserve banking. So in that sense, there is money creation that you put in $100 perhaps, and they can lend out 90, for example, because they only have to keep, say, 10%. But in actuality, this is also erroneous. This is incorrect. And so this is finally, you don't have to just believe me. This is in the literature now by Bank of England, the cradle of modern banking, Bundesbank. So it's slowly becoming into the mainstream, but it's still not there. And so what really happens is that when a bank issues a loan, they are creating brand new money, essentially. So I can explain that further if you'd like, but I don't know if you have
Yeah.
any questions there.
No, I want to break that down a little bit. So, because I certainly had understood we were no longer on a sort of the gold reserve approach, not understanding that that's sort of how it came about, which is interesting. But you're saying now that we're moving into a modern structure. Is that what's happening in terms of banking generally? Is that where because we're out of the gold, the holding of the gold approach,
Yeah.
and now we're into what?
Yeah, I don't want to get too into the nitty-gritty of monetary theory and all that, but that's sort of the basis of sort of banking, methodology or ideology. And so what I'll show you, well, actually, I'll tell you a quick anecdote, if you will, because I studied banking at a university in Portugal, actually, and there was a great professor. God bless her. She's great. She worked for the Central Bank of Portugal, and so I was hoping to learn about some of this banking. How does it work? Mostly the course, what most bankers do in essence is focus on regulation, big focus on Basel and sort of, accountants and sort of bureaucracy. So she
Sure.
basically taught the financial intermediation theory that banks take deposits and then we loan them out. And then I sort of had to put my hand up, my Brazilian classmate who works in the banking industry is beside me saying, okay, yeah, ask her, ask her. So I just said, don't banks create money? And she got a little flustered, but she essentially had to admit that they basically create new money. But maybe it'll be a bit clearer if I just show like a really simple. Uh,
Yeah, like how does a bank create new money?
yeah, are you seeing my?
Yeah, it's just coming up. There it is. Yeah.
Yeah, so this is a really simple illustration. On the left is just an example of a non-bank financial institution, which are able to lend, right? So what the difference is here, when a bank issues a loan, you'll see that they add the loan, the account payable is on the liability side when it's issued, but suddenly that is quickly converted into a client deposit. So what happens when a non-bank financial institution lends, they have to also provide you the money. So they give you the say $100 or 100 million here. Their balance sheet, uh, you see, doesn't grow, right? The loan is on the asset side, but they also have to pay out that money. But on the bank, as their privileged position, as the accountants par excellence for our society, they have the ability here to just convert that account payable directly into a client deposit. So what you're seeing is an extension of the balance sheet. Both at the same time, there's an asset created, which is the loan, but also the liability, which is the deposit, which is placed right into your account. So when you take on that mortgage, that deposit didn't come from anywhere else. It's not a previous deposit, but it is in essence new money created out of thin air, as it were. So there are some questions here, legally, ethically, morally, that are out of the scope of our discussion. We're more interested in how this affects the macro economy, but there are some interesting questions to be had there, especially that I'm talking here to a lawyer. There are no laws, actually. There's no law in Canada or most Western countries that allow for banks to create private money. That is supposed to be a sovereign um, uh, privilege, but we'll leave that mostly aside
Yeah, but
now.
that's interesting. So as long as you're a registered bank in Canada anyway, you're essentially allowed to create a loan, have someone borrow 100, as you say, $100, and then that on their books becomes a deposit to the recipient. And so then they can say my deposits are up by $100.
Yes.
And the recipient hasn't received anything except for the loan. And the money flows, of course, because if I borrow $100 and I buy a house and I put that down in a mortgage, then the person I bought the house from gets that $100. But we've just moved paper. We haven't moved or created anything in that process.
Um, no, there was, sorry, I
Is there
misunderstood.
money created though? Is there money created in the process of grabbing the loan? And where's the money? Like it was just a loan. The bank just put on their books $100 on their loans.
Well,
Then they
that's what happened. That's all that happened. So
right.
because all of the accounting in our society is handled by these institutions,
Right.
Because of that position, they are able, and there are some regulations that allow this and non-bank institutions not to do this that we won't go into, but there, that is new money. They just created that on their balance sheet with ones and zeros, right? This is all mostly on computers,
Right.
digital money. So it was just created.
So then, all right, and we're gonna have in another podcast a discussion about crypto and how that money wealth creation is there. But all right, so then without getting too technical, what determines who is to lend to who and where the credit flows? Like in that process is that obviously the bank is assessing the borrower and determining that that borrower will eventually pay that money back.
Correct, correct. So that's not deceive you. There are some constraints, right? There's not just
Right.
an infinite printing machine for
Yeah.
private banks. They are capitally constrained. There are the regulations, to your point, risk-weighted assets, all sorts of the technicalities which I've learned about in my class. But um, there are workarounds. The reality is that they're not extremely capitally constrained in that they can post lending, they can add to their capital reserves to fix that ratio. And there are some examples. For example, in 2008, Barclays Bank, they issued a loan of about $5.8 billion to a sovereign in the Gulf, an individual in the Gulf, who then turned around and used that money to buy shares from Barclays, right? So that's sort of a way that you can kind of use the privilege to, that's increasing your capital reserves,
Right.
but you printed the money to do so. So I'm not saying all the banks do that. So there are real constraints. So more to
Sure.
the thrust of your question, um, what determines who gets this money? And that's where we've seen in Canada that we touched on last time a biasing towards real estate because you're lending against
Yeah.
collateral. So
Right.
it's the risk weighting is much lower because you can take the collateral when the person defaults. And in Canada we haven't done as much none of the subprime stuff that we saw in the United States. But anyway, there's still a huge bias towards real estate. It's easy gains. There's a constant demand as we've seen for 50 years, partially government sponsored and sponsored by this easy credit creation. So it's a self-reinforcing cycle, and it makes sense. The incentives are there. It's stable, solid source of interest, and future buyers. But eventually, you'll see potential downsides or macroeconomic risks associated with this kind of growth.
Okay, so let's talk about that. Why does this matter to the economy globally, like generally to us, to you as a young person getting into the game and me getting out?
Yeah, well, this goes back into credit theory, and a great authority on this is Joseph Schumpeter in the early 20th century. He created the term creative destruction, but there's definitely a place for credit creation in the economy, and it's mostly was thought of at that time to be used for productive investment, infrastructure, businesses, and innovation, because those types of investments pay themselves off, right? So you even if you create new money, those businesses are hopefully going to be
Right.
productive and be able to pay that off out of their own earnings and future profits, right?
Right.
But with real estate, when you funnel this money into financial speculation and real estate assets, there's no mechanism for paying that off. So you just get an increasingly big debt overhang. And this comes into sort of my research, which is in the Canadian economy, we've seen a huge explosion in. Can you see my screen here?
Yeah, it's just coming up. Yep.
With so here in blue is the mortgage credit as a percentage of GDP. So not raw numbers here, but you just see a huge climb, right? And we see post 2001, we have the boom, and simultaneous with that is my other factor in my analysis, which is business investment as a share of gross fixed capital formation. So basically a proxy for productive investment. And it's not that these are necessarily cause at all. There's lots of other factors, but you can see sort of a general trend line. We see a stagnation and decline in gross fixed capital formation and just this ballooning mortgage credit. But eventually, this credit is going to have to be paid off, and that's where you have huge systemic risk baked into the system here now.
So basically, we're borrowing all this dough for our houses and it's not feeding our productive economy.
Yeah, exactly. So it's siphoning off resources that could be used for more lending for small businesses. And that's sort of a discussion we could get to later in terms of solutions, maybe in another video, where the backbone of the economy is really small, medium-sized businesses. But what this does is also draw in other resources, especially talent and capital. So, you see how many young really smart women and men that go into these sectors. Why wouldn't they? There's lots of incentives, easy money, but they could perhaps be better used in innovation, in creating new science, technology, or just starting businesses for their communities. So there's a big pull there away from sustainable growth in the economy. So that's why we see big stagnation. You may have read about falling productivity in Canada. I have another graphic here. Just, we're not comparing apples to apples here, but just to get a sense of the Canadian manufacturing stock, for example. Are you seeing here this?
Yeah.
Yeah, just to get a sense of what's also happened at the same time. We have a declining productivity and a weakening manufacturing sector in Canada. So those are the real outcomes, I think, of this. And that's sort of the argument of my thesis, that this real estate investment is crowding out what would be potentially productive investment.
Yeah, it's so interesting. And just to wind this up, the point you make about talent too, right? It isn't, it's a terrible thing, but we're not building entrepreneurs who are trying to, sort of create new AI tools or something because we're losing the funding to real estate and buying a house and pouring all the dough into that sector. That's really interesting. All right, well, listen, I think we've got a better sense of the banking industry today, and I really appreciate you going through that carefully with us. So this is another great learning moment. So thanks so much. I look forward to our next discussion and keep learning.
Thanks so much, Ian. I really appreciate it.
Talk to you soon.
It's a pleasure. Thanks.
Thank you for listening to the Radical Middle Podcast. Check out our show notes for further reading. For any inquiries, reach out at theradicalmiddlemedia@gmail.com.